Well, hi everybody. This is Marlis Carson with NCFC, and I want to thank you for jumping on our webinar here today. The Paycheck Protection Program has been extremely popular and somewhat controversial. And today we want to just talk about what are some of the patronage implications of participating in the PPP. Just want to note a couple of housekeeping items. As you join the webinar, you are on mute, but you'll see a green microphone on the side of your screen. And if you click that, or you see an orange microphone, if you click that and it turns green, that means you can be heard. Or if you're on your phone, you'll need to press *6 in order to be heard. We have several presenters today. We really appreciate them coming up with a presentation here quickly. The moderator is Jencik with Greendyke, Jencik and Associates. We also have George Benson with McDermott, Will and Emery, Teree Castanias with Teree Castanias CPA, and Eric Krienert with Moss Adams. We're going to run through a brief presentation and then give opportunities for questions. And you'll also see a chat feature on the side of your screen there also. With that, I think I will turn it over to Barry to get us started. Thanks, Barry.
Thank you, Marlis. Good afternoon or good morning to everyone on the call, depending on what part of the country you're sitting in. I hope everybody's doing well and safe. For today's webinar, what we're going to do is try to review some of the issues that cooperatives are facing in dealing with the tax and accounting issues, particularly to cooperatives who've received PPP loans. Obviously, you've read and seen some of the recent matters that have come out on this, and I thought what we would do first is run through a little background just to make sure everyone's on the same page on what the basic rules are. And then we will, the group of us have come up with questions that we think will hopefully address some of the questions you may have. And then when we get to the end, we're leaving enough time so that you can ask questions specifically that you may have. So let's talk about a little bit of background. As you probably are aware, the Paycheck Protection Program was established by the CARES Act, and a recipient of a covered loan can use the proceeds to pay for particular costs, namely payroll costs, which generally include payroll and healthcare related costs, and a few other particular items, other employee benefits, interest on mortgage obligations, rent, utilities, and interest on other existing debt obligations. The recipient can receive forgiveness on that indebtedness, generally equal to the sum of payments made for certain of these expenses during the 8-week covered period, beginning on the date of the loan origination. That is payroll costs, payment on interest of covered mortgages, payments on covered rent obligations, and covered utility payments. The amount of the forgiveness is also subject to a potential reduction if during the covered period the average number of full-time equivalent employees is reduced as compared to the number of full-time employees during a base period, or if salaries and wages of certain employees are reduced by more than 25% as compared to the last full quarter before the covered period. And the SBA also provided an additional rule that essentially says no more than 25% of the amount forgiven can be attributable to non-payroll related costs. Section 1106, little I of the CARES Act addresses the federal income tax consequences resulting from covered loan forgiveness. Specifically, that provision provides, I'll quote, for purposes of the Internal Revenue Code of 1986, any amount which, but for this subsection, would be includable in gross income of the eligible recipient by reason of forgiveness described in subsection B shall be excluded from gross income. So this section essentially excludes what would otherwise, under general principles of tax law, generally speaking, discharge of indebtedness income is includable in gross income under section 61, or if the income was considered to be other than discharge of indebtedness income, this provision is intended to otherwise exclude it otherwise from income if it was considered something else. Now, the IRS also recently on April 30th issued Notice 2020-32. This notice provides that any expenses that are funded with debt that has been forgiven would not be tax deductible. So this was something that a number of us thought might be coming out, but warrants certainly some discussion, and there's some issues surrounding that relative to possible potential legislation that will also cover relative to the effects of this notice. Beyond dealing with the obvious mechanical complexities of measuring the actual amounts of the loans eligible for forgiveness, and I know from my experience, most companies are trying to carefully track the receipt of those loan funds and how those monies are being spent. Cooperatives are faced with many questions dealing with the forgiveness of these loans, regardless of whether the loan forgiveness is entirely taxable, partially excluded from income, or potentially not excluded at all. And that really revolves around the character of the income to the cooperative. Is the income patronage sourced? Is it non-patronage sourced? Is it a mixture of both? And these questions certainly lead to other questions that involve the book accounting for these amounts, tax accounting, interpretation of your cooperative's bylaw provisions, questions of board governance and decisions boards may have to make, lots of other questions. What we're going to try to do today, we don't pretend to have all the answers. Certainly, this is an issue that is still in flux and still in development. We were talking before the call started how it seems the frequently asked questions that the IRS keeps posting on this subject keep changing as new considerations come up. This is a kind of a new world for everybody. So what we're hoping to do is try to identify some of the issues and the questions that you all are going to have to think about and consider as you make decisions around how to characterize this income and what you can do with it, what maybe you should or shouldn't be doing with it. Lots of other questions. We'll try to identify as many of those as we can. We'll talk about the implications of the new IRS notice and the potential for potential legislation that could change the effect of that notice. And we'll try to leave as much time as we can at the end for specific questions that you have. So what we'll do now is just kind of go through the questions that we've identified, and then I'm going to ask the panel members to kind of weigh in and discuss these questions. So if you're following along, flipping over to the next slide, kind of this really significant question most people are thinking about is, should the loan forgiveness be considered patronage income, non-patronage income? how should we be looking at how to characterize it, and what kind of guidance is out there? So I'm going to ask the panel if you all want to weigh in. Teree, I'll start with you. If you've given us some thought and have some views on this.
And Teree, if you're on your phone, you just hit *6 to unmute yourself.
Sorry, I was I'm on my phone if my computer is not that great on this. Well, I'm kind of coming into this late, but I certainly I think this becomes a difficult question for co-ops, because this is a completely, as you say, discrete event. It's not really related to anything that the co-op is doing. So you might want to think about it that way, but yet the expenses that are related to this potential forgiveness, the loan forgiveness, are probably related, at least in part, to your patronage purpose. They're for wages for employees that are doing things for the benefit of the co-op. So I guess my bias is always to kind of look to the activity and think about the patronage as following the activity, and whether if it's patronage related, then it follows that character. So, but I think obviously this is a really unusual event, and there isn't a lot of precedent, I guess, for it probably in the case law. I haven't looked at the case law yet. I'm sure George has, but this might be a place where you would think about things a little differently.
George, some thoughts?
Yes. What I find kind of interesting about this is that it may distinguish the accountant folks that come from this with starting with the accounting perspective, and the tax folks that start coming at it from a tax perspective. Because I think in the accounting world, and I'm not an accountant, I'm a tax folk, but in the accounting world, this is looked more like an income event, either from cancellation of indebtedness or a government grant that gets included in income. But when you look at it from a tax perspective, if you follow the notice 2020-32, this is really going to kind of flow through the tax return as an expense reduction. And I look at it, I think, kind of the same way that Teree does, which is that I think the characterization of this is really going to look to the characterization of your overall business activities. That this is really, in a sense, I think it's more like business interruption insurance, maybe, and which, from a tax perspective, you'd collect your business interruption insurance, but you'd reduce expenses. You can't deduct an expense that is covered by insurance. And so, if you've got a business that is 80-20 patronage, non-patronage, and you get forgiven loan, I would think it's probably going to be more in the nature of an 80-20 event in terms of patronage, non-patronage.
Mm-hmm. Eric, I know when we were talking about this, you had views similar to George on the nature of this being something like getting a business interruption insurance recovery. I don't know if you wanted to comment further on that.
Hey, Eric, you may need to unmute yourself. Yeah, thanks.
Oh, I thought I did already. Sorry about that. I think that's exactly how to look at this. In theory, if co-ops are getting this loan, they're likely going to have extra expenses in many areas, whether it's unproductive labor, additional costs associated with running the operation because of social distancing or other things. And so I do look at this exactly like business interruption insurance. But that being said, I think there's going to be some forgiveness that is going to be otherwise associated with normal activities. And we all, if we're on a tax basis, we kind of look at this and say, well, we don't have any taxable income, therefore there's nothing to allocate. But I kind of look at this as, a permanent item that will likely increase earnings and profit. And so I do think if a co-op wanted to allocate it as patronage, they could do so. However, I think this is really a good opportunity that co-ops can use to increase some permanent equity through either not allocating it or perhaps allocating it on a non-qualified basis, and show some clear intent that it's really long-term capital and there's no intent to redeem. So I think there's some opportunities to strengthen some balance sheets if all the costs aren't going to be used for extraordinary things, and I think co-ops should really consider possibly keeping it.
So it seems like in sort of thinking about the characterization of this, I think George and both you, Teree, alluded to looking at this from essentially looking at perhaps how the money was spent and how those costs relate to your activities, whether they be patronage related activities or non-patronage related activities, and that perhaps that really should be the way to characterize the debt forgiveness income, whether it's taxable or not taxable. And to the same extent, if 2020-32 is applied, that to the extent you have disallowed deductions, that perhaps you'd look at it the same way. You essentially look at what those deductions relate to, and allocate any deduction disallowance between patronage and non-patronage on the same basis. Is that essentially what you're thinking, George or Teree?
Yeah, that was my thought, Barry, as to how it would work, and at least in most situations.
Yeah, and this is George. I'd think sort of along the same way, and I think Teree, you'd said, well, are there cases, or there's certainly not any cases dealing with something like this. There have been rulings over the years where cooperatives have received settlement payments from various litigation from cases involving litigation where the damages were really tied into prior costs or expenses. So, for instance, years ago, there was a antitrust litigation involving corrugated containers, which of course, and people that were shipping fruit or whatever, bought a lot of corrugated containers, and it was alleged, and it was ultimately settled, or I think maybe it went to trial, and the plaintiffs won, that the companies had incurred higher expenses, and their settlement was tied into their expense amount. And that was treated as patronage / non-patronage, in effect based on, your overall activities. If it was 80-20 member, non-member, then, the odds are it was 80-20. And there've been a handful. There was what was called the stripper well settlement at one point that lots of cooperatives participated in, that was where the character was tied to the expenses. There was a vitamin settlement against manufacturers of vitamins used in feed where this approach was taken. I know there was a case where a group of people, a group of competitors tried to gang up on a cooperative, and an antitrust suit was brought, and the IRS actually ruled that the recovery replaced lost profits. And then last but not least, in the settlement of some of the recent antitrust cases against cooperatives, the cooperatives ended up paying money, but the recipients in part were grocery cooperatives who alleged that they paid higher cost for, and I'm not sure what exactly the ruling was, whether it was potatoes or eggs or whatever. But there again, the recovery was largely characterized by virtue of the alleged higher expenses they'd incurred in prior years. So there is sort of authority of tying back to the character of expenses that and activities at the end of the day that you're getting. Now, I don't think this goes so far as to say, well, when you apply for PPP loan forgiveness and you list expenses and you've got, say, $2 million of loan and you've got a pool of $3 million of expenses, I don't think you can just choose the non-PAD expenses if that's what you want this to be, or the PAD expenses. I suspect it's by characterization of the pool of eligible expenses that you'd look to determine the PAD, non-PAD percentage, not the ones you actually choose if you've got expenses in excess of loan proceeds. But that's just a sense. Obviously there's no law on any of this at this point.
Yeah, I was kind of surprised in doing a little research to not find, I couldn't find any cases or rulings dealing with cooperatives that had dealt with debt forgiveness. I mean, that kind of surprised me that issue hadn't come up before, but I think these,
It is surprising.
yeah, I think the analogous situations that George has mentioned, I think, make a lot of sense. The other area I thought about to look at was whether there's anything in the sourcing rules regulations under 861 that might provide some analogous guidance. There was actually a report issued, so I'm going to say it was 2005, by the New York State Bar Association that looked at, made some recommendations for how cancellation of indebtedness income should be characterized as insofar as U.S. source versus foreign source. And I thought that had some interesting corollaries to this, to looking at patronage versus non-patronage. What the New York Bar was recommending was that you'd look to the underlying interest expense and to whether the interest expense related to foreign source or U.S. source activities, and to essentially characterize the related cancellation income on the same basis. So I think that's kind of consistent, I think, with what we're really talking about. Certainly there's, potentially can be the temptation to try to, maybe, I don't know if I want to use the word game the rules, but, look at, what advantages might be had by allocating, expenses that are recovered or disallowed to either disproportionately to patronage and or non-patronage. But I think we're probably thinking that maybe that is maybe not the way to go with this. That looking at this on a proportionate basis probably is going to make the most sense, certainly for probably most of the co-ops that were eligible, given the size of those co-ops that were eligible to receive these loans. Eric, anything further to add? I know we were talking about some credits. There was some maybe potential analogy to treatment and tax credits that you've dealt with, I think, in some of your co-ops.
Teree, could you say that again? I'm sorry. I don't know if you directed that at me or somebody else.
Yes, it was a question for you. We were talking yesterday about, and I think you and George were talking about some credits that you thought there might be kind of a similar issue, or am I thinking of something else?
Yeah, I guess I'm not, not too familiar with the credit part. I think there's a lot of us who think that R&D credits, as an example, could be used, regardless of patronage or non-patronage, but I think the IRS thinks otherwise. I just generally thinking about this PPP and forgiveness. I really think it would be difficult for somebody to make the case that it would be all patronage, unless the co-op was 100% patronage, which, there's a few of those out there still, but not most of them. Making the case that it's 100% non-patronage, I probably something that could be done, especially if you wanted to support the fact that you otherwise wanted to retain that income as permanent capital.
Mm-hmm.
The only other thing that I think kind of comes to mind, and I don't remember how these rulings, maybe George does, but I think in the early 80s there was a lot of government buying and storing of grain, and I thought that was classified as non-patronage income, but I don't know if there's any way to make a analogy back to those rulings. George, does that ring a bell?
George, if you're talking, you're muted.
I'm sorry. This is the problem with doing these at home. The doorbell just rang and some flowers were delivered for Mother's Day. What was the question?
Can you repeat the question, Eric?
Sure. I was just thinking that I thought there were some rulings in the early 80s around the government storage of grain that was purchased from farmers, and I thought those rulings came out that they were considered not patronage. And I don't know if we can make some references to those as a way to guide us through this process as well.
Yeah, I think what you're remembering, Eric, is that there were battles over government storage programs from the CCC, and those really turned on whether or not the storage payments related to grain that was still owned by farmers or not. And if typically the CCC would make loans to farmers, and then at some point there'd come a point where the farmers could walk away from the loans in effect and keep them, but that was the price for the grain, and ownership then shifted to the CCC. And the CCC paid storage on behalf of the farmers while the loans were in place, and then paid on its own behalf. And anyway, bottom line was I think the payments from the government, as long as they related to stuff that was owned by the farmers, were patronage. I'm not sure quite I see how that would tie in here.
Yeah, no, I guess now that you're bringing more details, maybe it wouldn't apply.
Yeah. I know there were some cooperatives that when the tobacco price support program and the peanut price support program and some other price support programs went away, they received fairly substantial payments from the government, kind of to compensate them for the cost of those programs going away. And the impression I had was the IRS never issued any formal guidance as to whether those were patronage or non-patronage, and various people treated them various different ways, and nobody ever got audited on their treatment. So, but that was also sort of, government payments out of left field, compensating maybe for shutdown losses and other or at least losses of transition, which arguably were patronage sourced, at least in part.
Yeah, that makes sense too. So I think just, there's seems like there should be lots of flexibilities for co-ops to do these allocations and make arguments, a lot of ways. And I'm pretty confident that we're never going to get a black and white answer one way or the other. I would just be real leery of anybody saying it's 100% patronage. That would be the one area where I think probably pushing the envelope a little bit too far.
Yeah. Maybe the risk is if you treat it, let's say 80-20 based on your member, non-member, the risk is that you get the obtuse IRS agent who comes in and says, well, this is a payment from the government, not from a member. And it's 100% non-patronage. And then you'd be back, fighting over, and that's the thing we fought over, for years, like interest coming from third parties. Is that patronage or not? And you ended up, where people treat it as patronage, needing to tie it back into the business. And here 2020-32, in a sense, almost ties it back into the business for us.
That's a great point. Yeah, it's directly tying the income back to the extended expense.
Yeah.
On to the next page, the other series of questions that obviously all co-ops are going to be needing to deal with depend on whether the co-op distributes patronage on a book basis or on a tax basis, and the different considerations in that, and how cooperative bylaws, how specific they are regarding the definition of patronage income. I think from a GAAP perspective, my understanding, and I think unfortunately all the accountants on the phone are tax accountants, but I think from a GAAP perspective, this loan forgiveness would probably, for the most part, be considered as gain from debt forgiveness and treated as income for GAAP purposes. I know there are some considerations around the timing of that. There has to be a formal cancellation of the debt. So, you could have, depending on how these things time out, you could have potentially some timing questions on that. Depending on, what kind of documentation and comes out and when that happens. But certainly it seems in most cases, a co-op that distributes on a book basis is going to have this gain, whether it's excluded from taxable income or taxable, is going to be in book income. And so that, opens a bunch of questions for co-ops in terms of, does the board have discretion regarding whether that income is allocated to members or not allocated? If, could there be any funding issues if they have to allocate that income? And maybe the one big question that we talked a little about yesterday is, should the co-op be distributing that income? There's certainly, I know on the last PPP loan webinar that happened last, or was it earlier in the week, Marlis? The other.
Yeah, it seems like a long time ago, but I think it was this week.
That was more discussing the whole issue of the risk of how you make your case that the business uncertainty was there to such that you borrowed this money. Are there issues potentially for co-ops in actually distributing this gain to members? If particularly, the government comes in and audits, anything over 2 million. According to the government, they're going to audit, which I still have a hard time believing how they're going to do that. But
yeah,
if they're looking at this in hindsight and, you took that gain and distributed it to your members, does that create any risk to you as to whether you actually needed the funds to begin with. So I'd be interested in everyone's perspective on that on the panel, and these other kind of questions I've listed here. There's issues. Certainly boards have discretion here. There's, members are going to have questions about distributing this income. I suspect in many cases, management, that, oftentimes management is looking to try to create permanent equity, may prefer to not distribute this income, whether it's characterized as patronage or non-patronage or a little bit of both. And maybe this is particularly if the, I guess depending on if the income is not taxable and if, depending on whether the IRS notice stands or doesn't stand, there's potentially for creating permanent equity not subject to tax. But I mean, these are all issues that are going to be different for every co-op. It's going to depend on your bylaws and what your discretion is. So I'd be curious what everyone's views are on that. Start with Eric.
Yeah, I think, to the extent that a co-op does, want to allocate it, I would think it would be okay. And, I look at a co-op and their members as kind of one economic unit. And the fact that the co-op is there, ultimately means that the grower, the farmer, has less labor on their individual farm. And so, some part of this, if the co-op was applying for the loan and used its own payroll, it literally had the effect of increasing the grower's ability to get access to these loan programs, because at some level the co-op is doing the labor that would otherwise have been done on the farm, but for the co-op being there. And so I don't know that I would worry too much about, if co-op does decide to allocate it out to the growers. I think I would tend to worry about that, very little.
Teree, thoughts?
Yeah, I would agree with Eric's conclusion on that. If they want to allocate, I think that's certainly a fine. And for the patronage portion, I guess, kind of thinking about it too, that to the extent that a co-op's got a reasonable reserve provision in its bylaws, which virtually all of them have, the board and management could make some determination that some portion of this should be reserved. That would certainly be appropriate as well. So I think it'll depend a lot on the situation for each individual co-op and for the board and management to assess, what's happened to the co-op as a result of this pandemic, and what is it created in terms of needs in the co-op to retain some of that money. That would be the thought process I think you'd go through to try to determine, should we allocate it to the members who probably definitely need it, or should we keep some of it to keep the co-op going and healthy and able to continue to do service to the members. That, there's two sides to the coin. So.
Mm-hmm. George, thoughts?
I'd look at it maybe a little bit differently. Certainly from a tax perspective, particularly if 2032 stands, 2020-32 stands, book and tax income will be the same. Once you get over the patronage, non-patronage hurdle in your bylaws, it seems to me that, allocating would be a normal thing. But the one thing I guess I'd say as a cautionary thing is if any of the co-ops that may be listening to this are wrestling with the question of, should we pay this money back because our business is actually better than it was last year as a result of things that are going on. We're an essential business. We haven't shut down. If the co-op is going through that analysis, I would think they should talk with whoever is giving them advice, just to make sure that, you know, if the co-op thinks, well, yeah, we do plan to distribute this as patronage, throw that on the table to that advisor and say, what do you think? You know, is that going to hurt our case? Certainly would seem to me not to look good. But whether it's fatal or not, I don't know. I know for true loans that the government under the CARES Act would be making, or is talking about making, to larger businesses. Those larger businesses are required to covenant that they won't pay dividends or redeem stock during the period the loan is outstanding, and for a year afterwards, just to make sure the loan isn't distributed out to shareholders. Now, that kind of restriction is not specifically in the PPP program, as I understand it. But there are things in the PPP program where everybody is saying, well, we're representing, I think you have to certify in order to get a PPP loan that that the money that you're getting is going to go for wages and, you know, utilities and stuff like that. So I don't know. I think it's a bit of a gray area, and for co-ops that feel like they're on the edge and are considering repayment, they, you know, whoever is giving them advice, you know, it probably wouldn't occur to them that you guys would pay it out as patronage, or at least that's where the money would end up, and you should make sure they think about that in any advice they give you.
Let's talk a little bit about 2020-32. And Marlis, I know I said I was going to hopefully get Joe in on the front of this, and I've completely forgotten to ask him to comment. I don't know if he's still on the call or is on the call regarding or maybe a legislative fix, kind of where that might be.
Yeah, thanks. We do have Joe Mykert and Melissa Mueller from Capital Tax, and so we wanted to just get them to weigh in on where does this notice stand? Is there a chance it's going to be overturned? What's in your crystal ball there, guys?
Okay, Joe's on. Can you hear me?
Yes.
Oh, good. Okay. and I'm in a car, so nobody's going to be delivering flowers or anything. But so soon after the IRS put out their pronouncement, which Secretary Mnuchin said was, you know, Tax 101, the two chairmen and ranking member Wyden from the tax writing committees wrote into Treasury and IRS saying this is not our intended result. We wish you to reconsider this. I'm not sure whether IRS and Treasury will reconsider it. There was another issue regarding the treatment of healthcare expenses for the retention credit, which the same folks wrote into Treasury and told them to reconsider that. That they have reconsidered. But in any event, some bipartisan bills have been introduced on this issue, and I think there's a very good chance in upcoming legislation that we'll see this reverse. So there's three possibilities. You know, legislation reverses it and allows the deductions. Treasury and IRS change their mind and allow the deductions, or everything stands as is. So, you know, two good results, one not so good result. If I had a guess, and again, it's purely a guess, I think we'll eventually get to the good result here.
Joe, the eventually part is in terms of the timing that happens. I see this as most likely to be something that winds up in the next COVID relief bill, or is it something that might take a little bit of time, which could mean you'd have cost of the position prior to a legislative fix. Any thoughts on that?
Yeah, there is. The House Democrats will be introducing their next round of COVID relief bill. We understand that they are looking at fixes to the tax provisions from the CARES Act, including the retention credit. So I think this is something, and so we'll have to wait and see next week whether that's in that bill or not. In any event, this is not just a House Democratic idea. As I said before, it's Chairman Grassley's on the bill. I would expect that other Republicans in both the House and the Senate, will join that effort. So I think it's a bipartisan, bicameral provision. I think they're going to try to get it done as quickly as possible. We'll have to wait and see next week whether the House Democrats start that ball rolling by including it in the bill they hope to introduce.
Okay. Anybody on the panel have questions for Joe?
Joe, this is George. Has anybody suggested the idea that maybe the amount that is treated as not reducing expenses be like a capped amount? And say, well, look, you can, if you have 250,000 given, then you get expenses, but anything over that would reduce your expense, to try to focus this.
Yeah, no, I have not, George. The only thing I've heard is that the members said when we intended to give this tax-free treatment on the income side, we didn't think Treasury and IRS would take it away on the expense side. So that was our intent all along, was to make this completely tax-free. Some would call that a double benefit, but I guess IRS and Treasury would call it double benefit. But I haven't heard anything about capping it or anything like that.
Because if this gets reversed, then we almost need another session to talk about patronage implications, because it will result in a permanent book tax difference between book and tax income.
Right.
And that creates a lot of issues, both for book basis taxpayers who in effect will pay out patronage maybe and effectively creating net operating losses, or for tax base who may say to themselves, wait a minute, we've got book income, but we're not paying patronage because we've got all these expenses.
Well, I'll just think that through. But George, if instead of the legislation saying that all these amounts are deductible, if they made it elective to be deductible, would that take care of your issue, or at least give you an opportunity to take care of your issue?
Well, I think the issue would be kind of at that point as if can you go to the next slide?
Yeah.
This was just something that we put together to kind of illustrate what the book income and the tax income with and without the notice look like under a situation where the co-op, before getting all of this, have $75 of income and $100 of expenses. So it would have run a $25 loss. And then we've assumed that this co-op got $25 of people who loaned it to them $50. And if you look at it in the example from a book perspective, with the $25 loan forgiveness, the co-op breaks even with 50, it has 25 of income. And with notice 20-20-32, there's no book tax difference. You have the same 20-25 of income. But if there's no disallowance of expense, all of a sudden you do have a situation where with the loan forgiveness, the co-op still has $25 a loss either way. And it does create an issue as to, well, what then do you pay as patron? And I think, at least in a lot of instances, the book tax difference might be paid with on-calls or with other things. They're levers co-ops have. I don't know that we need to get the legislative relief to be co-ops. It just presents a different range of issues for co-ops.
Yeah, I think I agree with that, George. I mean, it might create some NOLs that potentially aren't very valuable, but I don't think we need anything special in the legislation.
Hey, can I just interrupt for a second? Joe, if you're not speaking, could you mute yourself? Because we've got a lot of feedback from your line.
Oh, sorry. Yep.
Thank you.
So, George, this example is, I mean, it's a great example too of, we were talking a little bit about yesterday of, this is where, the expense allocations or the allocation generally of the forgiveness between patronage and non-patronage. And let's assume for a moment that we wind up in the situation where 2032 is reversed. So you're down in, your book reporting in the first item, first example, the third example, tax no disallowance of expense. In both those cases, we're running tax losses, which, if you, with the addition of the or return of the carryback provisions and a 5-year carryback provision, certainly there can be temptation to look at how those losses are allocated between patronage and non-patronage. I think for a lot of co-ops, patronage losses, particularly those co-ops that are distributing most of their patronage income on a book basis, typically wouldn't have a lot of opportunity for refund recoveries on the patronage side, but they potentially have refund recovery opportunities on the non-patronage side. But I think getting back to what we talked about before, of sort of the 80-20 split, I think co-ops have to be cautious, particularly those co-ops that might be on the edge of, sort of the question you raised on, should we keep the money? If you couple that with somebody carrying back losses and recovering prior paid taxes, that might present some other issues for them.
Yeah, I agree. And this example, people should be aware that this just shows this shows net income before patronage. And it would get more complicated if you then said, okay, if you look at the right-hand column and you say, we pay our patronage based on book, and we're going to pay $25 of patronage, then when you start down to the tax, the $25 of income would get reduced by 25 of patronage to get to 0, which is so far so good. But if you get to the bottom one where 2020-32 is reversed, the 25 of patronage now would all of a sudden result in a $50 loss.
Right.
And if you carry that loss back, you'd better look awfully hard about and think hard about it, because my experience has been that co-ops almost never get audited, at least small co-ops, except when they file refund claims.
Right.
And the IRS really picks it apart. And as everybody knows, the loss area is, has been one of the more, and the loss carryback or carryover has been one of the more fought over areas with this pat, non-pat stuff.
Exactly.
But I don't know that we need to, to necessarily have a statutory fix, because I guess if you looked at it another way, is maybe the co-op, if we were in this disallowance of expense, maybe the book basis co-op would pay the 25 of patronage and non-quals. So they wouldn't be deductible, at least currently, and you know, you'd have a $25 loss for the tax, no disallowance of expense, but you at least wouldn't be increasing it by the patronage.
Right, you wouldn't be essentially taking advantage of the fact that you have $25 of exempt loan forgiveness that you're paying out and essentially goosing your tax loss.
Yeah. Now is that, you know, all of this, and I think part of this is, the whole purpose of this is to kind of surface issues. You know, as time goes on, we'll find out whether we really are in a world where 2032 is the law or it's been reversed, and people have a better idea of what their earnings look like, and how much loan forgiveness they have, and I think everybody's going to have to go through an analysis. You know, am I a book? Am I a tax? What do I want to do? What does it look like?
Right, I agree. Before we move on to questions people may have, anyone on the panel have anything else they'd like to add? Marlis, if not, if we want to open it up to anyone on the call that has questions.
Yeah, I wonder, did Eric, were you trying to weigh in? We were unmuting your line. We had a little feedback. Did you want to?
No, I don't have anything extra to add right now.
Okay. Then yes, let's take some questions. For those on the webinar, you can unmute yourself with the microphone icon. It turns green when you can be heard. Or if you're on your phone, please hit *6. And there's also a chat feature on the side of the webinar if you just want to write in a question. Barry, maybe we've answered all the questions.
Yeah, maybe we just did a really good job of ferreting out questions, or maybe people have dozed off. I don't know.
All right. Well, it seems like we did such a great job. We've answered everything, and I want to thank all our panelists, Barry, George, Teree, and Eric. Thank you so much for getting on the phone with us today, and also Joe Mykert and Melissa Mueller was also there from Capital Tax. We didn't get a chance to hear from her, but we will next time. Thanks, everybody. And also send me an email if there's something you'd like to hear on a webinar, questions you have, and we'll try to address those. So thanks, everybody, and have a good weekend. Bye.
Thanks, Marlis.
Thanks, Marlis. Take care.
All right.
Thank you. Thanks, bye.
Thank you.